For the Indian life insurance sector, FY 2026 was defined by external turbulence. Trade tariffs and geopolitical conflicts created a volatile macroeconomic environment, muting premium growth. This dual-axis chart tracks that reality. On the left axis, ICICI Prudential's retail APE volume effectively flatlined, growing just 2.2%. Yet on the right axis, profit after tax spiked 34.6%. Core operations drove a sharp divergence from flat premium growth. To understand how a life insurer extracts profit without volume, we have to isolate the value of new business, or VNB. Despite the sluggish APE, ICICI Prudential's VNB grew by 10.9%, reaching 26.29 billion rupees. This growth was driven entirely by VNB margin expansion. Over the fiscal year, the company pushed its profit margin on new policies from 22.8% to 24.7%. When a company delivers stagnant sales volume but double-digit profit growth, standard revenue metrics fall short. The numbers indicate that management is structurally engineering more value out of every single policy they write. They achieved this expansion through two specific operational levers. The first was a deliberate reallocation of their product mix toward high-margin retail protection. This chart tracks their retail protection volume across the year. The strategy accelerated heavily in the second half, culminating in a 60.5% year-over-year surge in the fourth quarter alone. The second lever focused on the savings line of business, specifically targeting the duration of the policy terms. Management extended the average policy term for savings products from 26 years in FY 2025 to 29 years in FY 2026. By locking in customer capital for an additional 3 years, the company structurally increases the present value of the future profits extracted from those policies. A 24.7% margin is an engineered outcome. By weighting the portfolio toward protection and extending savings tenors, ICICI Prudential set a higher baseline for its underlying structural value. This waterfall chart provides the direct link between management's projections and the actual fiscal outcomes. It deconstructs the embedded value to show exactly where wealth was created or eroded. Our starting point is the opening embedded value at the beginning of FY 2026. From there, we track the structural engine, adding to the embedded value operating profit, starting with the unwind contribution. Unwind represents the expected return on the existing in-force business over time. In FY 2026, the unwind adds a solid 7.4% to the opening EV. Next is the value of new business generated over the course of the fiscal year, adding another 5.5% to the total. Before calculating any external shocks, operational drags, or variances, ICICI Prudential's underlying structural engine generates a 12.9% gross addition to its embedded value. But that 12.9% gain does not survive intact. We have to factor in the negative variances that drag down the final operating profit. First are the operating assumption changes. The unavailability of input tax credits following the September 2025 GST reforms caused a permanent 0.5% hit to the embedded value. Second is a metric that dominated analyst questions, a 2.64 billion rupee negative persistency variance. Drops in 13th and 25th month persistency typically trigger concern for investors, as they can indicate a systemic decay in distribution quality or poor underwriting standards. However, the data isolates the specific persistency drop to a single product cohort, the industry-first 100% premium back annuity. Faced with a tight macroeconomic liquidity environment and negative market returns, customers holding this specific product aggressively surrendered their policies to access cash. The company safeguarded its immediate economic position on these surrenders, but the loss of these active annuity customers permanently erased the future earnings that had been modeled into the embedded value. This brings us to the final, largest downward step on the waterfall, the economic and investment variance, totaling a negative 7.78 billion rupees. Despite the market turbulence mentioned earlier, this variance was not driven by equity volatility. The impact was almost entirely concentrated in the debt portfolio. Specific shifts in the yield curve and rising interest rates forced a negative repricing of the underlying assumptions across their fixed income assets. An insurer can successfully re-engineer its product margins and insulate its books against stock market shocks, but macro debt pricing strictly dictates the final realization of embedded value. Netting these structural gains against the GST, persistency, and yield curve drags leaves us with the closing embedded value, 529.89 billion rupees. This final calculation yields a return on embedded value of 11.9% for FY 2026. To see why management considers this an underperformance, look at the gross components again. The 7.4% unwind plus the 5.5% VNB equals a 12.9% structural addition. It was only the 1% total drag from tax changes and surrenders that pulled the return down from that 13 to 14% capacity range. FY 2026 demonstrates a critical reality for life insurers. Even when the core underwriting engine successfully expands margins, the final return on embedded value remains highly vulnerable to isolated macro liquidity crunches. However, the way analysts calculate these returns is about to change as the sector transitions to a new reporting standard. The Indian insurance sector is adopting INDAS, aligning with global IFRS 17 reporting standards. While ICICI Prudential's board has secured a one-year forbearance, the transition is mandatory. For equity analysts, this means the complex embedded value walk we just tracked will soon be replaced by different metrics. Financial models must be entirely recalibrated. The market will shift its focus toward contractual service margin, or CSM, and standard return on equity. ICICI Prudential has proven its ability to defend margins in a volatile environment. The true test for investors in FY 2027 will be translating those underwriting realities into an entirely new global accounting language.